What is price action? How candles are formed on the chart, and most importantly, what is the mindset and psychology of buyers and sellers behind those candle formations? Let's understand these concepts from beginner to advanced level. Now, first of all, we will try to understand what exactly is price action. In this scenario, market opens at 1800 points level with a strong green candle, and after then market remained consolidated for about 2 hours at 1950 level. However, after 2 hours, price breaks this consolidation zone and moves up. Here, market makes a base and again continue its previous momentum. Here in this illustration, price creates a movement from one point to another. Whenever price has to go up and down, then price never proceed in a straight line. To move the price, presence of buyers and sellers in the market is essential. That's why price makes higher lows as well as lower highs, where different buyers and sellers mark their entry and take exit from the market. This action or movement in the language of trading is named as price action. Now we will understand why candles are formed and what is the exact psychology behind those candles. Here in 5-minute time frame, market opens at level of 1920 points and faces strong resistance at 1960 level. Now if we look closely, market is continuously facing rejections from 1950 level to 1960 level. This actually means whenever price reaches this level, then sellers again actively start their selling. Exactly like this, if we form a trend line by connecting the today lows, then whenever price reaches this level, buyers plan their entry and take the price further up. Most of the time, stop loss of sellers are placed in this area above resistance level, and stop loss of buyers are placed in this area below the support level. Now, interestingly, these two levels psychologically are the most important levels to be witnessed by traders, because whenever market break these levels, this will disturb the psychology of trader, because they will start exiting their positions in panic. Whenever price come closer to resistance area, the number of buyers start reducing in proportion, and size of the candle starts reducing, resulting in price unable to break the recent swing high. Now this means this was the last attempt of buyers to take the price up. After seeing this low buying pressure, sellers attempt to push the market down, resulting in formation of a strong candle after breaking the support area. Here, after seeing the breaking of the trend line, buyers start exiting from the market. However, some new buyers witness a new support line and start buying from that level, which results in price slightly pulls up. However, due to excessive selling pressure, price fails to hold up and again starts to go down. Here at the hammer candle, big institutions mark their entry for the last time, which results in the formation of big red candles. Now you understand the market psychology behind this breakdown. Now you must have witnessed in this zone that whenever price goes up, it forms small green candles, and whenever it goes down, then it forms big red candles. This means sellers are doing selling more actively as compared to buyers, and they are interested more to take the price below resistance level. You must have to understand that big institutions can't place all of their sale orders at one point as they are trading in huge volumes, so they always need liquidity in the market. That's why to form liquidity, price is pushed upward so that more retail traders start buying in the hope of resistance breakout, and sale orders of these big institutions are executed gradually. Whenever institutions feel that interest of buyers is decreasing, then they start selling in huge quantity, resulting in sudden fall of the price. Operators intentionally take the price near resistance level in order to feel the retailers that market will soon break out the resistance, resulting the retailers to fall in greed, and they start entering in the trade. Without resistance breakout, because they think if they don't enter in the market right now, then they will miss a trade opportunity with guaranteed reward. Whoever trader enter in this area, he has the feeling of FOMO, meaning fear of missing out, and they are just can't control this feeling. In this way, retailers fall in the trap of operators. Whenever you are planning to enter in the market, you have to understand these traps of operators, which we call smart money concepts. Then you can become a profitable trader. Now, after seeing charts, you have to keep some important points in your mind. First of all, whenever price trades in a range or trade in a consolidation zone, then you should avoid to enter in the market. Secondly, never make your trading decisions by just seeing one candle against the trend. Because if you ever think of entering in the market from here, then chances of your loss is significant. Thirdly, never trade with full volume until there is a breakout of psychological levels like trend lines, support or resistance with a strong bullish level, or formation of continuation candle. Fourthly, never make buying or selling decision only by seeing some candles before taking any trade. It is important to observe the overall trend of the market. Then you can mark your trade entries correctly. If you loved our video and wanted to see more price action analysis videos in future, then like this video and subscribe this channel for more beginner-friendly updates.